Hey, it's Dwayne here. I'm a mortgage agent based in Ontario. And if you're thinking about buying your next home, especially if you're upsizing, this video is for you. So today what I want to do is I want to walk you through a scenario that I created using my mortgage app to compare your different mortgage options. And I always like creating scenarios like this because this is similar to what I see. So here's the situation. You just received a firm offer on your current home that you were selling for $900,000. And you've paid your mortgage down to $350,000. So you've got a bunch of equity that you're going to get at the end of the day when you sell your property. So approximately about $550,000 in equity. Big chunk of money. And you're also pre-approved to buy your new home for up to about $1.6 million. You've been shopping around. You found the place that you love. You put in your offer. It got accepted. All right. So now comes the big question. What kind of mortgage should you get? And this is important and it could get complicated, so I want to try to break it down for you and make it really simple. Here's some questions that you want to think about, all right? How much of that big chunk of money that you just got from selling your property should you use for your down payment? Or, should you go with a fixed rate mortgage or an adjustable rate mortgage? Do you choose a 25-year amortization or a 30-year amortization? And how does that impact your monthly payments? In fact, what does your monthly payments look like? And have you budgeted for it? How much interest will you pay over the next 5 years? And what are your goals? Or is your goal to pay your mortgage off faster? Do you want to have improved cash flow? It's a lot, but I promise we're going to break it down step by step. And I'm going to do this by showing you your options and compare it side by side. Okay, so what we're looking at right now on the screen here, this is a report that I can deliver right from my mortgage app, and I do this with my clients. So what I'm going to do here is I just went on this morning, I went to realtor.ca, I found this listing. It's selling for just under 1.5 million. So starting from the column on the left, I want to show you all your options. Let's say you just want to put a minimum down payment. So out of that $550,000, you just want to put $150,000 down. Okay, but because you're putting less than 20% down, this is going to trigger default mortgage insurance, which adds just under $42,000 to your mortgage balance. So that's going to bring your total mortgage to about $1.39 million. And if I chose a 5-year fixed rate, let's say 4.19%, and a 25-year amortization, your monthly payment here is going to land at just under $7,500 a month. But let's say you want to take that same fixed rate, but you want to amortize that out over 30 years just to improve your cash flow and lower your monthly payment. So here you're going to put 20% down. So this is just under $300,000. So there's no mortgage insurance added. The mortgage amount here is lower at about $1.2 million. The rate is slightly higher at 4.29%. But what we've done here is we've stretched the amortization over 30 years. This brings your monthly payment down to just under $6,000. So that's a savings of just over $1,500 a month compared to the minimum down payment option. So that's some extra cash that you can use towards your savings, renovations, or prepayment privileges, which we'll talk in a bit. All right, so now let's talk about your next option. That's an adjustable rate mortgage. This option assumes that you're going to put 25% down. So it's just under $375,000 down. So no insurance required here. It is an adjustable rate mortgage starting at about 4.45%. Again, amortized over 25 years. The monthly payment here is just over $6,100, so $6,194. It's about halfway between the minimum down payment and the 30-year option. And then finally, we have the same adjustable rate mortgage, but we're going to extend that to a 30-year amortization, and we're also going to increase our down payment to 30%. So you're borrowing just over $1 million. You're going to be at a 4.5% rate, but again, 30-year amortization gives you lower monthly payment of just approximately over $5,200. So this is the lowest monthly payment on the page. We'll talk more about why that matters when we get to prepayment privileges and flexibility. So now that you've seen the side-by-side comparison, you can really start thinking about what matters to you most. Do you want to keep more money liquid? Do you want to lower your monthly costs? Or do you want to get your mortgage paid off as fast as you can? We'll dig into that next. So here's the only way to truly pay off your mortgage faster is to pay your principal down faster. And all lenders will offer you prepayment privileges. And this is a powerful tool, especially if you want to choose a mortgage with longer amortization and lower monthly payments, because you want to pay off that principal as fast as you can. So in this section, what I'm going to do is I'm going to apply prepayment privileges to a couple of the mortgages. So we've applied no prepayments to the first two options. So the minimum fixed at 25 years or the fixed at 30-year amortization, no prepayment privileges there. And as you can see, the effective amortization, or how long it would take you to pay off your mortgage if nothing changes, is exactly what you would expect, 25 years or 30 years. And of course, there's no interest savings because we're just following the regular payment schedule. Now, here's where things get really interesting. So let's start with the 25-year adjustable. Right? So we've added a modest prepayment here of an additional $500 per month and $5,000 annually once per year as a lump sum. With those extra payments, the effective amortization drops from 25 years down to just over 23 years and 2 months. And get this, you're going to save just over $19,000 in interest just from those small, consistent extra payments. Well, what if we ramp it up a little bit, but let's choose that last mortgage that we did, and that's the adjustable 30-year. Same idea, put a little bit more down, but we're gonna get a little bit more aggressive. Let's call it $1,000 a month. That's gonna hit principal every single month. And $10,000 annually as a lump sum using the lender's prepayment privileges. Because the monthly payment is lower to begin with on this 30-year mortgage, we actually have the cash flow and flexibility to do this. So that knocks your effective amortization down to 24 years and 11 months and saves you $24,000 in interest in just 5 years. So even if you choose a 30-year mortgage to get a lower monthly payment, it doesn't mean you're locked into being in debt longer. By using the prepayment payment strategically on your terms, you can speed up your path to mortgage freedom without losing the flexibility. So this is why we don't just chase the lowest rate. It's always about total cost, control, and setting up your mortgage to work for you, not the other way around. All right, now let's dig into one of the most important parts of your mortgage journey, and that is how much of your money is actually going towards interest versus actually paying down principal. So this section, as you can see on the screen here, is going to show your total payments over the first 5 years broken down by each mortgage scenario we're comparing. So we'll start with the minimum fixed option. So here you're paying over that term $447,891 total over 5 years. So that's $271,000 roughly in interest that you're paying, and only $176,000 roughly is going towards principal. So that means your mortgage balance after 5 years is still going to be roughly about $1.2 million. Now compare that to the fixed option with the 30-year amortization. Yes, your payment is lower at just under $5,905 per month, and your total paid is much lower at $354,000 roughly, but you've only chipped away at $110,000 of principal. So your remaining balance is still over $1 million. So your monthly payment is easier to manage, but it's a slower start when it comes to building equity. Now let's check out the adjustable 25-year option with prepayments. So here you've paid $417,000 roughly over 5 years. That's over $203,000 that went directly towards the mortgage principal. That's why the balance after 5 years is just $921,000, which is a massive improvement compared to your fixed options. And you've also saved over $57,000 in interest compared to the minimum fixed path. And finally, the adjustable 30-year with even more aggressive prepayments. Let's talk about that one. Here, you've paid a similar amount, overall $416,000, but you've knocked down the mortgage by $220,000, leaving a balance of just $829,000 after 5 years. That's a difference of nearly $377,000 compared to the minimum fix. So what does that tell us? Well, it tells us it's not just about interest rate. It's about how you use your mortgage. Prepayment strategies, lower starting payments with 30-year amortization, and the flexibility of an adjustable rate product can significantly change how fast you build equity and how much of your interest you pay. And this is why comparing total cost and principal paid is so much more helpful than just comparing monthly payments or chasing the lowest rate. Now that we've talked it all the way through, you have your different options. Just remember, there's no one-size-fits-all approach. It's always going to depend on your goals. If you have questions, if you want me to run the numbers, please reach out. Bye for now.